Okay, so let's dive in here, really unpack this document and get right to the core of what's happening.
Yeah, we're looking at the latest Form 10K filing for Broadcom Inc., AVGO. Big player.
Huge. Semiconductors, infrastructure software, the works.
Exactly. And this document, it's dense. Hundreds of pages.
Right. So our job here is to cut through all that, pull out the key stuff.
Make sure you walk away with a clear picture of the business, their financials, the risks, everything important.
And it's all coming straight from their official annual report, the 10K for the fiscal year ending November 3rd, 2024.
Yep. And just hitting some quick official points from the cover page, they're a well-known seasoned issuer, large accelerated filer.
And importantly, not a shell company. Good to know.
Definitely. And the scale.
Wow.
The filing mentions their non-affiliate common equity market value was over $583 billion back in May 2024.
It's massive. And what, nearly 4.7 billion shares out as of late November 24?
That's the number. So like you said, this isn't just numbers. It's a narrative about their strategy, challenges, where they're headed.
Okay, so let's start with the basics. Their business structure.
Right. It really boils down to two main segments, two core engines: semiconductor solutions and infrastructure software.
Two very different beasts in a way.
Absolutely. Different markets, different dynamics.
Let's tackle semiconductors first. What are we talking about here? What do they actually make?
So this is the hardware side. They develop really complex digital and mixed signal chips, mostly using standard CMOS tech.
But also some more exotic stuff.
Yeah, they mention analog products using materials like gallium arsenide and indium phosphide. The
Wow.
3V compounds.
What use those?
Performance. They offer advantages for things like super high-speed networking or radio frequencies where standard silicon kind of hits its limits.
Okay, pushing the envelope.
Yeah.
And where do these chips end up?
Everywhere, basically. The filing lists, enterprise, and data center networking, huge focus there, especially with AI networking now.
Right, AI is driving a lot of demand.
For sure. Then you've got home connectivity, set-top boxes, broadband gear, telecom equipment, smartphones, base stations.
Servers,
Yeah.
storage.
Yep, data center servers and storage. Also factory automation, power generation, alternative energy, even electronic displays. It's broad.
So how do they compete in such a crowded space? What's their angle?
They emphasize high-performance design, first off, and integration, packing more functions onto a single chip or package.
Makes sense. Less complexity for their customers.
Exactly. And they focus on target markets where they think they can get, attractive margins.
Like those SAS, RAID, and PCIe products they mentioned for servers and storage.
Precisely. SAS and PCIe are about high-speed data connections within systems, and RAID controllers are crucial for protecting data on storage arrays. These are vital data center building blocks.
Got it. Okay, now let's pivot to the other side. Infrastructure software.
Yeah, and this is where things have changed dramatically recently, mainly because of the VMware acquisition.
Right. So what's the goal of this software segment?
It's aimed at large enterprises, helping them simplify and manage their complex IT setups. Think mainframes, distributed servers, private clouds, hybrid clouds.
The whole tangled web.
Pretty much. And the filing notes that many Fortune 500 companies and government agencies rely on their software.
So mission-critical stuff.
Definitely. Their portfolio is designed to help these big organizations modernize, optimize, and, crucially, secure these environments. Make them more scalable, agile, automated, resilient.
What kind of software are we talking about specifically?
It's a wide range. Things like operational analytics, workload automation, database management, tools for application development and testing.
Security too, I assume.
Oh, yeah. Identity and access management, compliance and data protection, security insights. Also, DevOps support and AI ops.
AI ops, using AI for IT operations.
Exactly. Combining monitoring of applications, infrastructure, networks with, intelligent remediation. Trying to automate fixes.
And then there's the VMware piece. That's the elephant in the room, right?
It absolutely is. The VMware private cloud software portfolio is central now. The filing positions it as bringing public cloud-like scale and agility, but with the security and resilience benefits of a private cloud.
Lower total cost of ownership, they claim.
That's the pitch. And enabling digital innovation, faster infrastructure modernization, a unified cloud experience.
And a key feature seems to be the VCF license portability.
Yeah, that's important. Being able to move those VMware Cloud Foundation licenses between your own data center and supported public clouds, that flexibility is key for hybrid strategies.
They also mentioned some specific solutions built on top of VMware.
Right. Things like private AI letting companies run AI models on their own infrastructure, close to their data, for privacy and compliance reasons.
Makes sense. data sovereignty is a big deal.
For sure. Also, VMware Cloud Foundation Edge for managing stuff at remote sites, vSphere Foundation for optimizing IT infrastructure.
And some specific product names like Velerain for ML workloads, fixed wireless access using 5G.
Yep. And application networking and security solutions, zero trust security, load balancing, fighting malware, plus payment security stuff like SaaS authentication for banks and merchants doing online transactions.
Okay, so you've got these two huge segments, high-performance chips, and this broad suite of enterprise software. What's the overarching strategy tying it all together?
The stated goal is technology leadership, delivering category-leading solutions in both hardware and software.
And how do they plan to achieve that? Just build it all themselves?
No, it's explicitly a mix. Strategic acquisitions, VMware being the prime example, obviously, and extensive internal R&D.
So buy and build.
Exactly.
Yeah.
They believe this combination creates a robust business model, driving diversified and, ideally, sustainable results.
Okay, let's see how that strategy translated into actual financial performance in fiscal 2024, especially compared to 2023. This is where the rubber meets the road.
For sure, and the numbers definitely show the impact of their big moves. First, top-line revenue.
Yeah.
Huge jump from about $35.8 billion in FY23 to $51.6 billion in FY24.
Wow, okay, that's a massive increase. How does that break down between the segments?
That's the key. Semiconductor solutions grew, but relatively modestly from around $28.2 billion to $30.1 billion.
Still growth, but not explosive.
Right, but infrastructure software. That went from $7.6 billion in FY23 to $21.5 billion in FY24.
Okay, so that's almost entirely the VMware acquisition showing up in the numbers.
Precisely. That's where the massive top-line growth came from.
But revenue is only part of the story. What about profitability?
Right. And here the picture gets more complicated. Gross margin actually decreased. It was 69% in FY23, dropped to 63% in FY24.
Integrating a large software business, maybe different margin profiles?
Could be part of it, plus acquisition-related costs hitting cost of goods sold, and then operating expenses.
Let me guess, those went up.
Way up, more than doubled, from $8.5 billion in FY23 to over $19 billion in FY24.
Ouch. Why such a big jump?
Well, R&D and SG&A were higher, but the really big drivers mentioned are acquisition-related amortization, writing off the value of acquired intangible assets over time, and restructuring costs.
The costs associated with integrating VMware.
Exactly. So you combine that lower gross margin percentage with much higher operating expenses.
And operating income actually went down, despite the revenue surge.
Correct. It fell from $16.2 billion in FY23 to $13.5 billion in FY24.
That's counterintuitive. Bigger company, less operating profit.
It highlights the immediate financial impact and costs of such a large acquisition.
And the bottom line, net income.
That saw a really significant drop, too. Net income attributable to common stock went from $14.1 billion down to just under $5.9 billion.
Wow. So less than half of the previous year.
Yeah, and that flows straight through to diluted net income per share, which dropped from $3.30 in FY23 to $1.23 in FY24.
So bigger company by revenue, but significantly less profitable on a net income and per share basis in the first year post-acquisition.
That's what the reported numbers show for FY24. Now, on the cash flow side,
Better news there.
pretty solid. They generated nearly $20 billion in cash flow from operations in FY24.
Okay, so cash generation is still strong.
Yeah, and they returned a good chunk of that to shareholders, paid out about $9.8 billion in dividends, and bought back $7.2 billion worth of stock.
Keeping shareholders happy, despite the lower net income.
Seems to be the strategy. Oh, and also worth noting, they did that 10-for-1 forward stock split in FY24, so all the per-share numbers reflect that split.
Right, important context. Okay, let's maybe dig into some of the accounting details.
Yeah.
Sometimes those tell you more about what's going on under the hood.
Absolutely. Revenue recognition is always key. They recognize it when control transfers, separating product sales from subscriptions and services.
Any interesting notes there?
They mention recognizing $2.4 billion in FY24 revenue from performance obligations they already had on the books from prior periods, basically fulfilling past contracts.
Okay. And what about future revenue visibility?
They talk about remaining performance obligations, or RPO. That's the contracted revenue they expect to recognize in the future. As of November 2024, it was about $20.5 billion.
That sounds like a lot.
It is. And they estimate about 43% of that, so maybe $8.8 billion or so, will be recognized as revenue within the next 12 months.
So that gives you some baseline predictability, especially with the VMware subscription revenue now in the mix.
Exactly. It's a key metric for understanding future revenue stability.
What about valuing all the stuff they own, especially after a big acquisition?
Yeah, valuation of assets like goodwill and intangible assets is critical. They have to review these annually or more often if needed for impairment, basically, checking if they're still worth what they're carried at on the balance sheet.
And that involves judgment calls.
Huge judgment calls, significant estimates using methods like discounted cash flow analysis.
And this ties back to the VMware deal again, right?
Yeah.
Because they acquired a ton of goodwill and intangibles.
Precisely. The filing shows they booked over $54 billion in goodwill and over $45 billion in intangible assets from the VMware acquisition alone. Massive numbers.
Intangible assets like what? Brand names? Technology?
Yep. They specifically mentioned the VMware trade name, customer contracts, in-process R&D, IP R&D, and developed technology.
And you mentioned this was a critical audit matter.
Right. Their independent auditor highlighted the valuation of these acquired intangibles, especially the IPR&D and developed tech, as a critical audit matter.
Maybe.
Meaning it involved particularly complex and subjective judgments from management, relying heavily on estimates about future cash flows these assets would generate. The auditors spent extra time scrutinizing these areas.
So a lot rests on those future projections being accurate.
Absolutely. There's inherent uncertainty.
Okay, what about income taxes? Always complex for multinationals.
Definitely involves significant judgment there, too, dealing with deferred taxes, valuation allowances for whether they'll actually realize tax benefits, and uncertain tax positions.
Uncertain positions.
Yeah.
Like disagreements with tax authorities.
Yeah, potentially. They noted having accrued $701 million for interest and penalties related to various tax matters as of the fiscal year end.
And tax incentives play a big role for them.
A huge role. They benefited from tax holidays or incentives, primarily in Singapore and Malaysia. These decreased their tax provision by about $2.2 billion in FY24 alone.
Wow, that's a significant boost to earnings.
It is, but it's also flagged as a risk. If those incentives change or expire, they mentioned current agreements run until 2030 in Singapore and 2028 in Malaysia, their tax rate could go up substantially.
Right. And did their overall tax rate change much in FY24?
It actually increased compared to FY23. One reason cited was an internal transfer of intellectual property to the U.S., which changed the mix of where income was earned and taxed. Different jurisdictions, different rates.
Makes sense. Any other flags in the accounting notes? Concentration risk?
Yes, that's mentioned. One single customer, a distributor, accounted for 28% of their net revenue in FY24. That's up from 21% in FY23.
28% from one distributor. That seems high.
It is significant concentration. This revenue was primarily in the semiconductor segment.
Is the distributor serving one specific end customer or many?
The filing adds some important nuance there. They note that while a large chunk of shipments might go to locations like China, 20% of total revenue in FY24, those are often components that then get built into products sold globally.
So the ultimate end market exposure isn't solely China, even if the distributor ships there initially.
Exactly. But the reliance on that specific distributor is still a notable concentration risk.
Okay. And what about debt? You mentioned acquisition costs earlier.
Yeah, their total indebtedness is substantial, nearly $70 billion aggregate principal amount as of November 2024.
$70 billion. That's a big number.
It is. And they clearly lay out the risks associated with carrying that much debt.
Touches.
Makes them more vulnerable in economic downturns, exposure to rising interest rates on their floating rate term loans, less flexibility for future investments or acquisitions.
Could put them at a competitive disadvantage.
Potentially. And it means a significant chunk of their cash flow has to be dedicated just to making debt payments, principal, and interest.
Did they take on a lot of this debt specifically for VMware?
Yes, the filing mentions specific term loan facilities, A2, A3, A5, taken out in 2023 related to financing the VMware deal.
But they've started paying some back.
They have. They used proceeds from issuing new senior notes and also from selling off VMware's end-user computing, EUC business, to make repayments on those term loans in FY24.
Okay, so actively managing the debt load. What about dividends? You mentioned they paid a lot. Is that policy set in stone?
They state they have a quarterly cash dividend policy. But, and this is crucial, actually, declaring and paying those dividends is always at the discretion of the board of directors.
Not guaranteed.
Not at all. It depends on the financial condition, results, cash needs, those debt covenants we just talked about, and other factors.
Plus, they're a holding company, right?
Right. So their ability to pay dividends ultimately depends on getting dividends from their operating subsidiaries. The filing explicitly says there's no assurance of future dividend payments.
Good to keep in mind. Anything else interesting on the financial management side?
One technique they mention is accounts receivable factoring.
Selling their receivables.
Yeah, basically selling the right to collect payment from certain customers to a third party, usually a bank, on a non-recourse basis.
Non-recourse meaning Broadcom isn't on the hook if the customer doesn't pay.
Correct. The buyer of the receivable takes that risk. Broadcom gets the cash faster. They sold $5.9 billion worth this way in FY24 and reported the cash received as operating cash flow. It helps optimize working capital.
Interesting tactic. Okay, let's circle back specifically to the VMware deal itself. It clearly dominates the narrative for FY24.
No question. The filing confirms it closed November 22, 2023, right at the start of their FY24.
And the price tag was enormous.
Colossal. Roughly $30.8 billion in cash, plus 544 million shares of Broadcom stock. That stock was valued at about $53.4 billion at the time.
So an $84 billion transaction, roughly.
In that ballpark, yeah. Plus, they assumed VMware's outstanding equity awards for employees who joined Broadcom.
And we talked about the balance sheet impact those huge goodwill and intangible asset numbers.
Right. That's mostly the purchase price allocation showing up. The premium paid over the fair value of VMware's tangible assets.
Did the filing mention any lingering issues from VMware's side?
Yes. There's a note about a securities class action lawsuit filed back in 2020 against VMware, alleging misleading statements about their backlog and internal controls between 2018 and 2020.
Pre-acquisition issue.
Correct. A motion to dismiss it was denied in 2023, but Broadcom notes they've now agreed to settlement terms, which are just pending court approval. So hopefully resolving that inherited legal issue.
Okay. Every 10K has that big section on risks. It's basically the company outlining everything that keeps them up at night. What are the big ones for Broadcom?
Well, competition is a given. Fierce in both semiconductors and software.
Standard for tech.
Yep. Manufacturing risks for the hardware side, capacity constraints, yield problems, that's always there.
What about people?
Huge focus. Attracting and retaining qualified people, especially engineers and technical staff. They mention the intense competition for talent, particularly in places like Silicon Valley and Southeast Asia.
Immigration law is mentioned as a risk, too.
Yes. And they highlight the importance of their equity awards in keeping key people.
Makes sense. What else? IP. Regulations.
Yeah. Both are big. Protecting their own intellectual property is vital, and they also rely on licenses from third parties. Navigating complex regulations is a major challenge, especially global trade issues.
Thinking about tensions with China, import-export controls.
Exactly. Government actions, restricted entity lists, these can have a direct impact given their global footprint.
And cybersecurity must be high on the list.
Absolutely. They state they're a target as a critical technology vendor. Geopolitical instability only increases that risk.
Do they acknowledge past incidents?
They mention experiencing attacks and intrusions in the past, and the difficulty of integrating security across acquired companies like VMware. Insider threats are also noted.
Vulnerabilities from third-party code.
Yeah, or even accidentally exposed source code. It's a complex threat landscape. The filing does outline their governance structure for this, though.
Board oversight.
Yes, the board shares oversight with the audit committee. The CIO and CISO provide regular reviews to the committee, and the full board gets quarterly updates. Shows it's a top-level concern.
What about their R&D spending? You said it's significant. Is that listed as a risk?
It is, in a way. The risk is that those big investments might not pay off quickly or successfully. They might fail to develop the right new technologies or focus on things that don't get widely adopted.
Especially with the things changing so fast in AI and cloud.
Exactly. And one more common tech risk, dependence on a limited number of suppliers for key materials or components. Supply chain fragility.
Okay, that covers a lot of the potential headwinds.
Yeah.
What about the governance structure itself? How the company is run?
We touched on the board's role in cybersecurity oversight.
Right, shared with the audit committee, regular updates from management.
Yep. They also discuss legal proceedings more broadly. They're involved in various lawsuits, commercial disputes, employment issues, tax arguments, IP battles, and regulatory investigations. Standard for a company this size.
But potentially costly.
Definitely. Outcomes are uncertain. While they state they don't currently expect any ongoing matters to have a material adverse effect, they acknowledge the inherent uncertainty and potential expense. IP litigation is singled out as particularly complex and costly.
And internal controls. Who signs off on those?
The CEO and CFO are responsible for establishing and maintaining disclosure controls and internal controls over financial reporting. Their external auditor audits the effectiveness of those financial controls.
And they provide certifications.
Yes, the CEO and CFO provide certifications in the 10K. Importantly, they state there were no material changes to their internal control over financial reporting during the fourth quarter of FY24.
That's the quarter immediately after the VMware deal closed. So they're saying controls remained effective through that integration period.
That's the assessment reported.
Anything interesting for stockholders in the governance section?
Standard stuff on common stock rights, dividends, if declared, liquidation share, no preemptive rights. But they do list several provisions that could potentially deter a takeover or change of control.
Like what? Poison pills?
Not exactly poison pills, but things like authorizing undesignated preferred stock, which the board could issue with special rights, rules making it harder for shareholders to call special meetings or nominate directors, specific requirements for proxy access.
No stockholder action by written consent.
Right. And choosing Delaware courts as the exclusive venue for certain internal disputes. These are fairly common anti-takeover mechanisms.
But they can make it harder for shareholders to force changes if they're unhappy with management.
That's the potential downside, yes. The filing acknowledges these could delay or discourage takeovers that some shareholders might want.
Okay. Any other sort of miscellaneous interesting bits tucked away in the filing?
A few things. They have defined benefit pension plans, although some are frozen to new entrants. The investment strategy for their main U.S. plan is described as liability-driven, heavily weighted towards fixed income to match future payout obligations.
Makes sense. Foreign currency. Big global company.
They operate mainly in U.S. dollars, but they do use forward contracts to hedge against currency fluctuations. They state it's for hedging, not speculation.
What about employee benefits beyond salary? Stock plans.
Yep, they have an employee stock purchase plan, ESPP. Eligible employees can buy Broadcom stock at a discount the lesser of 85% of the market value at either the beginning or the end of a 6-month offering period.
Nice perk. And other stock compensation.
Yes, they grant various equity awards, including market-based restricted stock units, or SUs. These often vest based on performance conditions, like achieving certain total stockholder return, TSR, compared to peers, or hitting stock price milestones.
So tying compensation directly to shareholder value.
That's the idea. Valuing those market-based awards involves complex methods like Monte Carlo simulations, as noted in the filing.
Wow. Okay, we have definitely gone deep into this 10K. That was a lot to unpack.
It really was. We've seen how Broadcom is managing this massive scale, juggling the semiconductor and now vastly expanded software businesses.
Navigated a year completely reshaped by the VMware acquisition, huge revenue growth, but also significant hits to profitability metrics and a big jump in debt.
Yeah, and we pulled out some key underlying details and the importance of things like RPO for future visibility, the complexity and judgment involved in valuing those acquired assets.
The impact of tax incentives, the concentration risk with that one distributor, the ongoing cybersecurity challenges.
It hopefully gives you, our listener, a much more informed, nuanced picture than just looking at the headlines.
Absolutely. You've got the key facts, the strategic direction they're pointing towards, and a clear view of the challenges they themselves identify, built piece by piece from their own report.
So you're better equipped now to understand this complex tech giant and the landscape it operates in.
Definitely. So here's a final thought to leave you with, building on everything we've discussed. Given Broadcom's sheer scale now, the incredibly fast pace of tech change they live with every day, and the complexity of integrating these enormous hardware and software operations globally, how does a company like this truly ensure its internal controls and risk management systems, especially for critical areas like cybersecurity and that complex financial reporting we talked about, genuinely keep pace?
Keeping pace with that level of rapid expansion and the evolving threats.
Yeah, how do they make sure those systems are robust enough for the reality they operate in today, not just yesterday? Something to think about as you watch Broadcom and the wider tech world